Hello everyone, my name is Ben MacNevin from Montgomery Investment Management and welcome to this week's video insight. Well, a big part of the value that we add to our investors is the amount of market information that we collect from industry experts. Over recent weeks, we've had many meetings with leaders in the construction sector, including architects, builders of residential dwellings and offices, and managers of hotels and resorts. I'd like to share a few of their key insights. Overall, it seems that confidence has returned to the market, with activity increasing across the industry in terms of both supply and demand. For the past 7 years, supply has been relatively subdued, with growth heavily influenced by market sentiments. Developers typically require a positive outlook for 6 to 12 months to justify an investment, yet the amount of bad news in the economy has continually pushed back projects. Since the 2013 election, it seems a lot of this negative sentiment has waned and growth is returning. Supply is also benefiting from easier access to capital. You see, while interest rates have been at record lows for a prolonged period, it seems that financial institutions are becoming more confident with the state of the economy and are comfortable to relax lending requirements. The cost of land is now one of the biggest concerns in the industry. In New South Wales, it is estimated that taxes and levies comprise over 40% of the price of a new house. Now, the industry is seeing moderate cost pressures as labour availability has improved dramatically since the end of the mining boom. Now, on the demand side, the record rates of auctions speak for themselves. There has been particular demand from overseas interests, and a concern for the industry is the growing number of buyers that are purchasing properties but leaving them vacant, which will support the already high prices in the market. Now, hotels and resorts are experiencing considerably strong demand, with occupancy in the major cities consistently above 85%. For a number of years, the segment has experienced pressure on room rates as booking engines make it easier for consumers to grab last-minute deals. It is unlikely that the booking period can shorten any further, which means that rates should benefit from sustained occupancy pressure. So, how have we at Montgomery Investment Management interpreted this feedback? Well, as value investors, we typically have minimal exposure to cyclical industries, and so we won't be rushing into companies tied to construction. But for us, the clear takeaway is the level of optimism that the industry experts shared in their outlook for the sector. For the first time in a number of years, confidence is increasing with the project pipeline, which should have positive implications for the market. Now, this may continue to support prices across the share market, which we consider is a little on the expensive side. Well, that's it from Montgomery Investment Management. I hope you have a wonderful Easter with your family. Please follow us though in the interim on Facebook and Twitter.